Let me just say that I expected the government, the plunge protection team, the powers that be, were going to try and keep this stock market propped up into Black Friday. But this just doesn't do anybody any favors when you try to prevent the market from its natural, from having natural corrections. You can see that this rally has been almost straight up. There's nothing here that even vaguely looks like a half cycle low. And as of today, we're 37 days into this daily cycle. So I've covered this before. Uh, when these cycles get really late in the towards the end of the daily cycle, then when the correction comes, it has to compress the entire correction into a very short period of time. The normal timing band for a daily cycle low, and this would be the bottom of the low, is usually between 38 and 45 days. You can see we're 37 days into the cycle, and we haven't even started a correction yet. And so you can see what's happening here is they're preventing the correction. It probably tried to start naturally last week, but the futures were rammed higher this morning. Like I said, they're going to want to keep this market propped up, try and prevent a correction ahead of Black Friday. And all they're doing is they're allowing the market to stretch further and further above the long-term mean. Now that seems really bullish to dumb money retail traders that trade on their emotions. The longer they see a market go up, the more confident and the more bullish they become. Whereas somebody that understands how markets work, a professional trader, a smart money trader, this makes them very nervous. When price gets stretched a long ways above the long-term moving averages, a smart money trader gets nervous and wants to lock in profits, because they know what happens is eventually the market regresses to the mean. And as I've pointed out in the past, these cycles that rally very late into the end of the cycle, they tend to, when they do correct, they tend to correct as typically as some kind of crash event where the correction has to unfold very quickly in a matter of just a few days, as opposed to how it would naturally correct, which would be over a period of a couple of weeks. And so you can see this in play. The correction from this top, you can see price got stretched way too far above the long-term moving averages, and then the correction, when it came, it occurred over just a series of a few days, and it occurred as a crash. Same thing here, and then of course we had the Fed that tried to keep cutting rates a little too long, and we end up getting our 4-year cycle low and a crash far below the long-term moving average, which of course stretched the rubber band too far in the other direction. So then you get a very powerful rally to the upside. We get our next daily cycle low again. Market is propped up ahead of the FOMC meeting. We get far too deeply into the daily cycle, and then the correction unfolds as a crash event very quickly over the matter of, this was 4 days. This correction here was a little more natural, but then again, the market was propped up for the FOMC meeting, and now it's being propped up further ahead of the holiday buying season, Black Friday. And so all they've done is they've managed to stretch this rally into the very end of this daily cycle, and they've manufactured the conditions for a crash when the correction does occur. And it would not be completely out of the question to drop all the way back down to the 200-day moving average and do it over a very short period of time, 4 to 6 days. So while most people, retail traders, they see this to become very bullish. They start looking for fundamental reasons why the market can't go back down, and then they end up getting caught at a top when they really should take a step back, look at the long-term charts, see how far price is stretched above the long-term mean, and they should be very nervous here, not trying to conjure up fundamental reasons for why the market can't correct. We had something very similar in silver back here. We're very late in the intermediate cycle. We get these very emotional rally days at the very end. Traders, gold bugs, inventing reasons for why the metals can never go back down, and something has a paradigm shift has occurred, and the metals are only going up from this point on. This is where the dumb money retail traders are piling into the market. Of course, none of them wanted to buy down here when we were getting bullish. Now they're ready to buy, and they end up buying at the top because they've convinced themselves that something fundamental has changed. And you can see price was just stretched way too far above the long-term moving average. Smart money traders, ignore the imaginary fundamentals for why silver can't go back down, and they start taking profits. And then once the profit-taking event starts to gain steam, then all the retail traders that bought up here, they start getting stopped out of their positions as the market doesn't keep going higher like they assumed that it was going to, and then they just get caught in an intermediate correction. But we're closing that gap between this high and the long-term moving average. So now is the time that I want to be looking at putting my positions back on in the metals, and I want to become very nervous about long positions in the stock market. All right, so moving over to a chart of gold. Last week, I said that the banks were going to attack gold, try and move it back below this October low and stretch this daily cycle. They did manage to do that Friday. They're getting some more follow through today. At this point, I'm going to assume that they are going to be able to break this low right here and take gold down a little closer to the 200-day moving average. I would change my mind if gold can get back above 1465. If it can close back above 1465, then I would change my mind. But at this point, I'm going to assume the banks are going to be victorious this time, and the hedge funds are not going to be able to trap them into a short squeeze. So, I would just at this point I would just have a partial position in metals. We're pretty close. We're 39 days into the gold daily cycle, so we're running out of days in this cycle. We should get our final bottom here soon. It's probably going to come as a marginal break below this low. That will cause gold bugs to panic. They'll start inventing reasons for why gold can never go up. The exact opposite back here, where they were inventing reasons for why gold can never go down. At the intermediate bottom, they invent reasons for why gold can never go back up. Same thing happened here. Same thing happened at the intermediate cycle low before that, and before that, and before that. This never changes. But the bottom always comes, and as I noted in my last video, this is a very bullish correction pattern. Gold hasn't really given back that much of its gains, and it's mostly just gone sideways, which sets it up to quickly recover this intermediate high during the first daily cycle advance. So I want to be looking at taking profits or very tight stop on stock market trades, and I want to be looking for potential panic days to add more to my long positions in gold right now.